that China announcement could come today or tomorrow. Keep expectations low, but we'll see if if something does come through. I mean, they're promising and they're making all kinds of noises, but they've not really, put the firm numbers down in terms of what they plan to do. Will we hear some of that before the end of this week? I think is something to watch out for. The index is indicating about a 0.5% higher start. We'll just run through the market open. It's also a red-hot primary market, right? I mean, 3 IPOs opened yesterday, and I think IKS Health opens today. We'll have the management join us a little later. So a lot of action really coming through. What do we have? The bell should go on any time. Yeah, there you go, 24,640. It's, we've got unchanged. 3-4 point change on the Nifty. The Sensex also is extremely flat. The Nifty Bank is starting kind of sideways, nothing very much on it. Mid-cap index is up about 0.25%. So at least, the initial rate, broader market's doing a little better. 30 stocks are up and about 20 are lower. That's the overall picture. 25 points lower on the Nifty now. 24,624 is where we are coming at. It's almost 3:1. Stocks are still opening, but at least for what it's worth, at this point, 3:1 is the advances to decline ratio for what is open. And many more are opening, and the number will change. We'll track that. So that's the broader picture this morning. Let's get to stocks.
Very quiet. Absolutely nothing moving. Some of those steel stocks that we were discussing, metal and ferrous and non-ferrous both. There's some green there. Hindalco, for instance, is the Nifty winner right now, 1.2% on the higher side. There's JSW Steel, but there's barely a tinge of green. 2 rupees up. That's about it. ONGC, 0.5% on the upside. Remember, overnight we had a bit of an upwards bid on oil prices because of talk of more sanctions on Russia. On the banking side, things are very split. IndusInd and ICICI are managing. IndusInd and Axis are managing a bit of green, but even that's changing as we speak. HDFC Bank is quiet. On the losing side of the screen, there is SBI Life, there is Apollo Hospitals, BPCL, Titan and Trent, Asian Paints, Tata Motors. So the early trends are that some auto stocks are seeing profit taking. Pressure is continuing on consumption. Lever is also slightly lower. But metals are the winners so far in the open. And IT is not too bad. IT is contributing on the upside. TCS, for instance, is about 0.6% higher. Infosys, HCL Tech also. Small green on these stocks as well, but very quiet. What is this? 1 point down, 2 points up on the Nifty.
Well, that's right, but plenty of stocks actually moving around. Surabhi from the broader markets, Nuvama and Newland, because of those large trades. Both of them, that large trade on Nuvama has got done, 8.5% equity changing hands. So both those two have opened up a little bit lower. Gopal Snacks, as should be mentioned, unfortunate incident, one of their units, so that's down close to around 10%. We'll try to get in the management to clarify with regard to that. ITI has cooled off. It's cooled off now yesterday as well as today. So after the one-way up move, well, it's cooling off quite a bit. It's corrected close to 10% from the high we saw day before yesterday. Keep an eye out on that one. Jupiter Wagons, though, continues to do well. That one, in fact, is buzzing in today's trading session. Up and about in trade. And a couple of other notable movers. These ones are going from circuit to circuit, actually. You have Kernax. That stock is up. It's up close to around 5%. It's in the circuit. And the other one is Shakti Pumps. They won that order. So that one as well is higher in trade today. Edelweiss, that'll be a beneficiary because they get the money that's coming out of, out of this large trade. So that's why that stock is well up close to around 3%. So good going. We're flattish, mildly in the green. The breadth of the market, though, is telling you that mojo seems to be back for the bulls.
Vari Energy is another one which I just want to highlight. Vari is the second biggest volume-led gainer right now. It's about 2.5% higher, 32.47 on Vari at this point. Yesterday you had some of these solar companies which were looking up. Morrison Laboratories is up about 2.6%. It's got large volumes, and that's the reason I'm mentioning it here. Shakti Pumps got a very large order. The stock is up 4%. 850. That's the, I think, stock was, there was a split. Stock was almost $5,000. So that's done extremely well, Shakti Pumps. Afcons is up about 1.6, 1.7%, 532 on Afcons. There is Delivery, which is up about 2.5%, 390. Gland Pharma about 2.5%, 3%, 1826. Texmaco, and of course, all these railway names like yesterday are starting higher. Acme Solar is up 3%. Office is up another 3.5% after yet. There was a big block, and of course, stock ended 10% higher by close. It's above 800 rupees. That is Acme. Lemon Tree Hotels is coming up with a 2% pop at about 125. But then volumes, you go down the list, volumes start to thin out very quickly at this point. I think you guys mentioned Newland Labs. Newland is down 6. Nuvama, of course, that block 4.5 lower. Nuvama is just sort of giving up a little bit of the gains of, and that too only with the last 2-3 days because it's done so well. Bajaj Housing is down about 3%, 136. Swan sharply moved higher. It's back to the February high. There a double top in creation, we'll see, but slightly lower. Jubilant Food is down 3. PNC Infra was a big mover yesterday, down 2. And so it goes. So that's the first rates which are coming through.
Yeah, I just wanted to mention that two stocks which are reacting to news. The move on Wari, it actually started ahead of the news. The news came in yesterday post-market hours that they will be setting up a solar plant in Madhya Pradesh. They've got an order, so maybe there's a bit of a flare that's continuing. 3.5% up and building on that. And on Gland Pharma, the news is that they've got an approval for a blood clotting drug. I think it's an injectable. And that's working well for that counter. So two stocks reacting well to positive news flow.
On Wari, as I said earlier, the news was that there is going to be more protection on those that are producing solar cells. And they are moving from modules. They're getting backward integrated into cells. And also there is the stock that the US is going to set up plenty of solar facilities. They'll require more modules as well. So that's why, these guys could be excited. So it explains why I think Prashant was highlighting a couple of days ago. It was 2,600, 700. And it's moved up on the back of all these factors.
Okay, well, Andrew Holland is with us, Chief Executive Officer at Avendus Alternate Strategies. Andrew, good morning. Good to have you with us here. Thank you for your time. Newer segments, I think, right? Because, if you think about it, some of the conventional sectors, so as to speak, growth rates have slowed down. Earnings growth, etc., has slowed down, and it's not trivial, right? The pace at which earnings growth has come off for the large conventional sectors. Now, you can spot a banking there and say, well, maybe things are looking better. So let's talk non-conventional in that sense, non-traditional. Solar, for example, is one. These are newer industries where there is opportunity. But again, valuations are a bit of a problem. Just your thoughts, Andrew, for some of these newer non-traditional areas, and what's the top idea, top theme?
That's the difficult one, Prashant, is that, wherever you look, there's a valuation problem. It could be because it's getting earnings downgrades, and therefore, some of those traditional sectors you're talking about are being hurt because of that, because the top line and margins are under severe pressure. And some of the kind of new age technology stocks and new kind of areas are seeing that, that's where the growth is. But the valuations are also quite rich. So you're kind of caught between, looking for value in the traditional sectors, but knowing that the downgrades are coming, and not really wanting to kind of pay up for some of the high growth areas. The areas that we talked about, the themes we talked about before was obviously electronic manufacturing. And I think that's a great one. I would pay up for these companies, because I think there's a 3 to 5 year runway of which they could make huge amounts of top line and bottom line profitability. So that's one area I would continue to look at. But with solar, the prices are coming down. I'm just not sure that it's an area that I get more excited about. I can see it in the electronic manufacturing sector, but I'm just not so keen on the kind of solar part of the business in terms of the pricing pressures I expect will happen going forward.
So, okay, like the electronics manufacturers more than the rush for renewables, perhaps. Andrew, good to have you on the show today. So I think, a slightly broader question. The market here has had a good run, but now as we enter the new year, the question is, what will take it higher? Which is the sector that can have leadership? Can FMCGs be in the doldrums? Can banks take on that mantle? Will it continue to be some of these capex and manufacturing-related stocks? What's your sense?
So my feeling is that I think, the market is hoping for this extra kind of Santa Claus rally. FIIs will kind of, pack up and go off on their holidays soon. And therefore, the tendency is, don't sell in this month because you usually get a reasonable return. And then, of course, going into January, you will have all the kind of expectations for the budget. Notwithstanding that, obviously, President-elect Trump will obviously take in administration at that time as well. So I think volatility is going to be a little bit more in January. But what I would say is this, is that I don't think the banking sector, as much as I've been a bull on it, can really take the mantle at the moment. GDP growth is way below expectations. And I know that the forecast is for around 6.8%, but I think it's going to be near to 6%. So there's a lot of pain to come yet. So I would hope that the government starts spending. So I would probably go for the capital goods. I'd probably look at that sector as being where you can see at least some contracts being awarded. Doesn't necessarily mean that it's going to hit the bottom line, but usually share prices move in this sector when they get awarded contracts. So if I was thinking of any one sector to lead, it would be capital goods.
All right. Hi, Andrew. Good morning and good to see you. When I recall you were hinting that maybe the FI selling will cool off in December. We'll have a better end to the year the last time we spoke. So that seems to be the case, at least as of now. They've returned back to the Indian markets. At least they're not selling. But a couple of themes that you've been very bullish on. And two come to mind, particularly since we're in this seasonally strong period for them. Aviation as well as hotels. What are the stocks you play out there? Because in aviation, you have two of them. One is the leader and one is the one that's struggling for survival. But there could be something on the plate because if the industry does well. So would you stick to the leader or would you look at the second player? And also in the hotel industry, Indian hotels out of nowhere, I think in the last 45 days, the stock is up 15% or thereabouts. Your view?
Yeah, well, there's. I mean, obviously, I would play the leader in the airline space because I think that's that's where I think the more kind of revenue and bottom line profitability is going to come over the next 1 year. So I think that's an easy call to make. And also, I think fuel prices will come down as well. So I think that would be an extra kind of tailwind. Sorry for the pun, tailwind for the airline industry as well. In terms of hotels, I mean, as well as I do, just getting a room anywhere. I was seeing some prices for Goa for Christmas, and they're just unbelievably high. So the hotel industry, and I think there's a few IPOs coming as well. So I think the theme in terms of experiences and travel is not going away. And I think one of the things that gives me even more kind of positivity on the sector is that foreign tourists have really still got to pick up. So if that was to be the case, then this would obviously be an extra kind of revenue line for all the hotel companies across India. So I think that's one extra boost. I don't think the market's kind of penciling in to their earnings forecast, but I think that's coming as well.
The thing is that when 1.3 billion or nearly 1.3 billion people start consuming or investing in stocks, we tend to be pretty much enough for ourselves, right? Whether it's inbound tourism or whether it is just investing in the market, right? It's been the story of Indians doing what they do for India. But so you mentioned that capital goods could be a sector to look at. But Andrew, again, going back to the bigger projection for 2025, are you expecting it to be a more range-bound year for the market because of the growth concerns that you mentioned? And just, walk us through what would your top bets be? What would you strictly avoid? Because there's still a big debate out there on urban slowdown, perhaps FMCG is not really moving higher, so on and so forth.
Yeah, it's a tricky one actually, because if I just think about India from where we are, then obviously I am expecting the economy to slow quite quickly. Obviously, we could see interest rates fall as well, which would be good for the banks at some point of time in 2025. But the one thing that's holding me back from saying which sectors and which companies are going to do well is obviously what's going to happen when President-elect Trump comes in. And I think that's we're all saying one narrative at the moment. It's going to be higher tariffs, lower tax rates. Lower tax rates in the US could also mean lower tax rates in Europe as well. So this means that flows will not necessarily come to emerging markets. So I think it's going to be not an index play. I think it's going to be individual themes, which we talked on a few of them, which will continue to play out, because I don't see earnings growing more than 10% next year. And if it's 10%, then that's the kind of return you would expect for the market. So it's not going to be a bumper year in terms of in terms of the markets. And that's the best case scenario.
Got it. Okay. All right, Andrew. Appreciate you joining in. Thanks a lot for giving us your thoughts. Wishing you a good day ahead. By the way, a couple of stocks have recovered a goodish bit from the lows of the day. Gopal Snacks was down 10%. Volumes are not very, very high. That's now down close to around 4%. And ITI, that float factor plays out there. The stock was lower. It's recovered a goodish bit. If you pull up the intraday chart, you'll see now the stock has moved to the high point of the day. And just one more stock is, Bajaj Housing Finance. There is a part of that lock-in for some investors that today open up. So could explain the reason why that stock is a little bit under pressure because of that. So now it's down close to around 5.5%. Just looking at a Nuvama note. And they mentioned that today is the day where part of those stock that, you couldn't sell earlier, some part of those investors can do it. So that's why
that explains the decline. This happened with Swiggy also yesterday because part of that lock-in post-IPO opened up and then there was pressure on the stock. So ditto playing out with Bajaj Housing Finance as well. Okay, but for the time being, let's shift our attention back to a couple of corporate conversations. The company on our radar is now Bikaji Foods. And there is, of course, a big debate around potential slowdown in demand. So is this really happening or is it very different for the foods business? And what are the inflationary trends currently looking like? Well, we have with us the management joining in, Manoj Verma, Chief Operating Officer at Bikaji Foods. Manoj, great to have you on. Thank you for joining in. So let's just start right there because some of the companies, they've been flagging off. I mean, these are FMCG companies, not foods per se, but they have been flagging off concern overall in palm oil prices, the inflation. What has that meant for you in terms of edible oil, inflation inputs and also the general sense on demand? Tell us the trends that you're noticing so far in the third quarter.
Good morning and thank you so much for inviting on the channel. I think what you spoke about is absolutely right. The palm oil prices in past couple of months has gone up far beyond what we had expected. Earlier it was trading at 80, then it went to 100, 120, and now at 140 kind of a stuff. So yes, this is putting pressure on the bottom line. However, to a certain extent, these prices are being passed to the consumer. But I think, in this quarter, we'll see further prices going up. So that's going up to the consumer, right? And in terms of the palm oil prices, we feel that it should not go beyond this. This is at the peak, which is what we believe.
Can you just tell us how much is the price hike that you have taken in Q3 or in October, November, if you could tell us monthly? To what extent have you passed on the inflation and, what more will need to be done if you are to protect your margins completely from this palm oil inflation?
So pressure started coming on in the end of Q2, right? And in Q3 beginning, we started passing the price, but not to the fullest. What we had already done is about 2 to 3% prices have already been passed. And I think there is a scope of further 2% more prices would go up.
Okay. All right. Hi, Manoj. Good morning and good to see you. So you're passed on some kind of pricing, but what does this do then to your volumes? Are you seeing some kind of impact? Earlier, I think you were targeting 13 to around 15% volume growth and 2 to 4% price growth for the year. But now you've already taken a couple of price hikes. So have you exceeded that 2 to 4% price growth and volumes still intact, the targets that you had?
So we haven't exceeded 4% price growth for now. But yes, I think by end of the year, for this quarter, certainly, that kind of price would go up. And in terms of volume, of course, with the prices going, so much high, so there would be a little bit of impact on the volume growth, but still it will be a high single digit or a double digit growth for sure.
Earlier, you were guiding for 13 to 15%. So now you say that maybe it could be a little bit lower than that. Could it be in that vicinity of around 10 to 12%?
Could be, yeah.
Okay, all right. Help us out with your margins as well. What should the outlook be? Part of that input cost spike, you have managed to pass on, but there's still some more to go. You'll have the benefit of some operating leverage if demand is good enough as well. But what should the outlook be in terms of margins? So,
without PLI, we've been talking about 13.5% EBITDA. With these kind of prices, unforeseen stuff and all the prices not being able to pass, I think this would impact, say, by about 100 basis points.
Oh. So margins are going to be hit by 100 basis points despite the 2-3% price hike.
2%.
We understand.
Yeah.
Yeah, but you're going to take another round, right? That's what you're saying. You will take another round now.
Yeah.
But you're still penciling in about 100 basis points of a margin hit. So that makes it very clear. Now let's talk about growth itself. With this kind of price increases, is there any impact in growth, any down trading? Is there any change in grammage that's happening?
So when we say price increase, so no price point packs such as 5 and 10 rupee, where you do not have an opportunity to increase MRP. So it's a fixed price point. So that's where the degrammage comes in.
Okay.
However, in the large pack, which is not driven by the grammage, that's where the price increases do happen. So it is on both sides.
Okay, all right, Manoj, tell us about the sweets portfolio then. I think it was around 12.5% of your total mix. But during festive times, it goes up, I think, to mid-20s. How was demand for that? Was it good enough? And did it go to those levels that you expected?
Yeah, so sweets did extremely well. If you look at the right way to look at season for sweets is Q2 and Q3 put together, because it depends on early Diwali or late Diwali that impacts Q3. So Q2 was a fantastic growth, mid-20s, which is what you just spoke about. However, Q3 will be less, but sum total, if you look at, would be about close to 10% sweets growth. In terms of demand, I think there was no issue. There was a demand by far than what we could supply. And at certain point in time, we had capacity constraints as well. So otherwise, festive season was very nice and a very good growth we delivered.
So can you give us growth projections? That's the sweets portfolio you're talking about. But Mr. Verma, can you give us growth projections for the full year? I mean, we're practically down to the third quarter is also almost over. Given the issues that you described, full year volume growth, what is the expectation, and also overall top line growth for this year?
So full year volume growth, what we said, 13 to 15%, we would stay with that stuff only. That's where we would be. In fact, if we talk about the stationery category, is exactly in line with what we said, 13 to 15% we are falling in. So that's where it is, and I think by end of the year we should be in line with the overview or the indication what we gave to all of you and to our stakeholders as well.
I think it still could be 13 to 15%. Earlier, you were hinting it could be a little bit lower, right?
We said 13 to 15%. We would stay with 13 to 15% kind of a growth.
Got it.
Yeah.
Got it. 13 to 15% volume growth.
I said 13 to 15% would be value growth.
Value growth. Got it.
The prices going up would be a little lower than this.
So what's the revenue? Okay, let's come to top line. Top line target is 13 to 15% for this year, FY25.
Right.
Okay, got that. All right, we'll leave it there. Manoj, thank you very much for joining in and giving us some perspective on how consumer companies are battling this rise in palm oil prices. He's saying despite the price hikes, there will be an impact of about 100 basis points on the margin. Take a quick break. On the other side, we'll have the management of Inventor's Knowledge Solutions joining in to talk about the issue, which is opening out, and of course, the business outlook.
Welcome back. Markets up about 30 points or so. Let's shine the spotlight on Container Corporation, which is down a little bit. Mangalam is here to tell us why. Mangalam, morning.
Well, despite the markets being higher, Container Corp is lower, largely because of Goldman Sachs' negative note. They already had a sell call in the stock. Now they believe that there could be further downside. So they've cut their target price from 810 to about 710. Why is it that they see further downside? Because, you know, H1 volume growth for the company was close to around 6%. And now October, November as well, the run rate was just similar to what was in the first half. That tells you that their guidance of 18% volume growth for this year seems ambitious and at risk as well. So as a result of which, despite the correction, they see further downside on the stock because there are market share concerns amid rising competition too. At the same time, they believe this is just, the continuation of earnings downgrade cycle for the company. And as a result of which, the stock doing weakly in today's trading session.
All right. Thanks very much, Mangalam, for that. Just a couple of more names I want to highlight, and then we'll go across to the IPO, which is opening today. Swiggy, pull that up. It's down about 2.5%, about 509. Is a very good run post-listing, but coming off a little bit. And, of course, the others we've been highlighting, Nuvama, Newland, Bajaj Housing, they've all been in the mix from the word go this morning. Jubilant Food, I think we highlighted. Reeves Cotton is taking a bit of a breather. That went up $100 very quickly, down about 2%, 2.5%. There's NTPC Green, which is down about 2%. And I think Surabhi was talking about Gopal Snacks. There was that fire stock was down 10. I think it's recovered about 5 from the day's lowest point. Well, let's shine the spotlight on the primary market. Red hot, right? IKS Solutions, 2,500 crore IPO opens today for subscription. It's an offer for sale, 1.87 crore shares. To discuss this in some detail, we have Sachin Gupta, Whole-Time Director and Chief Executive Officer of the company, and Nithya Balasubramaniam, Chief Financial Officer at IKS. Thank you very much, Sachin and Nithya, for joining us here in the studios.
Thank you for having us.
Sachin, we're speaking to you for the first time. Nithya is a known entity for us because she was the pharma analyst at Bernstein, so quite a switch.
Thank
Nithya,
you. Fabulous to be back chatting with you and your viewers.
In your new avatar, and great to see you. It's a company with no real listed peers and we'll get to growth projections and all of that in just a bit. But just very briefly, Sachin, if you can explain, what does the company really do? And because you work in the US, what does it do in what area? If you can give a brief snapshot.
Sure. So look, I think the whole genesis of the idea is based on the scale and inefficiency in US healthcare. If you think about it, India is about a $3.3 trillion economy growing at about 6.5% real terms. US healthcare is a $4.8 trillion industry growing at 6.5-7% on a secular basis. And I think, the US, we call US the temple of capitalism, and capitalism stands on these two pillars of efficiency, technology and globalization. And yet the largest industry in the US, which is healthcare, seems to have under-leveraged these two pillars of efficiency, technology and globalization. And our whole idea was to bring these two pillars of efficiency to the US healthcare provider segment. The payer and the pharma segments had already leveraged these pillars, but the provider segment had not. And within that 4.8...
Which is hospitals?
Within that $4.8 trillion, we deliberately decided to focus on a segment called the physician group segment, which is the physician clinics, as they call it here in India. Now, that market segment alone is $1.5 trillion.
In terms of spends?
In terms of their revenue that is reimbursed through physician clinics. And we realized that segment was going to become the new fulcrum of healthcare delivery. Traditionally, hospitals used to be the fulcrum of healthcare delivery. We now realize the physician groups would become the fulcrum because remember, 90% of healthcare dollars in the US outside of end-of-life care are spent on chronic lifestyle disease management. You try to manage chronic lifestyle disease, diabetes, COPD, congestive heart failure from the hospital.
What's the difference between physician groups and hospitals?
So if you think about it, that's the outpatient clinic, where the freestanding clinic where the physician takes care of the patient. And our whole idea is physicians need to proactively take care of patients with chronic lifestyle diseases so that they prevent them from disease states that take them to the hospital, which will then lower the cost of care and perhaps improve the quality of care. Hence, that physician space, that physician clinic becomes the most important point in healthcare. And that $1.5 trillion industry, we predicted as that becomes a new fulcrum, will start consolidating rapidly. A lot of private equity money coming in, also a lot of the hospitals and health systems buying the clinics. As that consolidation would manifest, finally, what was a cottage entrepreneurial industry would start to mature and they would start to look for areas of efficiency. And we built a very simple model.
So what do you do for them?
So we built a very simple model that essentially identifies what is the chore tasks that these physician practices should not be focused on. The reality, the statistic is nurses are spending more than 50% of their time on non-patient care, non-discretionary tasks. We built a technology-enabled platform that takes away all of these chore tasks so that they can focus on their core of patient care, which frees up more time. That means it improves the number of patients they can see, that improves access to care. They're also
so
able
what
to
are
take
these
proactive
tasks?
care.
And so you provide software?
Yeah, so we basically use a combination of technology. Our first instinct was just write technology to eliminate these tasks. Some of these tasks are clinical in nature, like clinical documentation, medical coding, prescription refills. And then some of these tasks are purely administrative in nature related to billing and collections. Our first instinct was just write technology to eliminate these tasks. But because we are pragmatic, we also realize that technology often needs human in the loop to truly eliminate the task. That's where our India strength came in, where we could deploy India-based global human capital to supplement the technology, to supervise the technology. We have 7 or 8 Gen AI cases going on there. So, those often have biases, the Gen AI hallucinations. So the human supervision comes from our India-based workforce. And through a combination of the humans and tech, we're able to eliminate those tasks for these people. They're spending 15% of their revenue on these tasks. Prashant, that's $225 billion. Put that in perspective, the entire Indian IT services outsourcing industry today is $250 billion. So we had found a TAM nearly the size of the entire Indian IT services outsourcing industry, growing at 7%.
Yeah, I just have one question. So what you're describing sounds fantastic. I mean, it's a sitting duck opportunity, perhaps. I don't know how others didn't see it. But looking at the financials, and we'll just put them up for our viewers as well, revenues have grown in a very nice way from 760 crores in FY22 now to northwards of 1800 crores as of FY24. Now, I'm just trying to understand a business like this, what margins does it operate on? Because you were at 38, 39%, now it's about 31%. But isn't this a low entry barrier business as well? Can't a lot of the other, tech biggies, including the Indian tech companies, can't they come in and simply disrupt and drive margins lower?
So actually, to the contrary, entry barriers have become very high. So, if you think about it, what did we do over the 18 years? We actually built proprietary technology in very close collaboration with these healthcare enterprises because the workflows are very nuanced. It's not a standardized industry. So we actually co-developed this technology across these 16 tasks, which we call features of our platform. And that co-developed technology sort of has become our moat. And because it's a tech-led human-in-the-loop offering, the margins are at that 38, 39%. The reason they dropped to 31% last year was because we acquired a company called Acuity Solutions, which has a very large customer base. IKS traditionally had about 35,000 physicians under management. There are 900,000 physicians in America. IKS had 35,000 physicians under management. We acquired Acuity last year that actually has 120,000 physicians under management. So together that's 155,000 physicians, which is 18% of all of America's physicians. That becomes now our captive customer base into which we can cross-sell our entire platform, which forms the growth thesis for the next 10, 15 years. As we cross-sell our platform across these 155,000 physicians, it creates a captive opportunity of up to $28 to $29 billion. Today, we are about $315 million in revenue. So that creates that massive growth opportunity.
So it was because of this acquisition that, last year there was a dip, but then what's a steady state? I mean, is 30, 37, 38% steady state margin for your business?
No, we're suggesting, we're seeing margins in the range of early to mid 30s as we stabilize. So if you see our first half fiscal 25 numbers that just got updated in the RHP, we're back up to 28% margins from the pro forma 24% that we had dropped to last year. So that 28% starts to reflect that climb back to the early to mid 30s, which is where we hope to stabilize. And that's because we continue to intend to increase our spend in R&D. We spend about 5.5% on R&D as a percentage of revenue. We expect that to go up to 7.5%, 8% because we're building so much Gen AI and making investment in technology. And that's why we're saying we'll stabilize in the early to mid 30s.
Okay, all right. Hi, welcome to the studio and thanks a lot for joining in. I've learned a lot from Nitya over the years and good to have you, Sachin, as well. You're telling us about a new subject, something that we don't talk about very, very often. But let's get a couple of questions out of the way. Sure. This entire, offer is in OFS. So most of the money goes, to the person that's selling. It doesn't come to the company. How is the balance sheet looking as of now? How do you fund growth? Point number one. Point number two, earlier you all were looking at selling, I think, 2.8 crore shares, which has now come down, I think, to around 1.8 crore. Why so? Yeah,
so first of all, the business has always generated healthy cash. With those EBITDA margins, our EBITDA to operating cash flow conversions have always been 100%. So up until last year, we had about $100 million of net cash on the balance sheet, no debt, after paying $50 million in dividends. And we acquired Acuity for about 220 million in cash, because of which we had 100 million cash, so we took on $120 million of net debt. But the business continues to generate healthy cash.
So much of cash, you'll be debt-free in the short term.
Next year. So there's no need for primary capital.
So that's out of the way.
And the OFS is simply because, the way our cap table is, between the two promoter families, Mr. Jhunjhunwala's family and me, we own about 70% pre-IPO.
Yeah.
25% odd is owned by employees and ex-employees. And about 5% is owned by some HNI board member types that came in early. 18 years later, our employees that have put in their blood, sweat and tears had seen no liquidity. So I felt like it was time to offer that. And that's why we're doing this 16% OFS. 10% of the 16% is being sold by employees and 6% is being sold 3% each between the two families.
But why was it scaled down from 2.8 to 1.8?
Actually, that was just because we did a pre-IPO. We had so much demand for the IPO that because we wanted to make sure we are allocating appropriately to the best investors, we did a small pre-IPO round.
Okay.
Nitya, come in here. So in the US, and this is a slightly high-level question. We can go micro once again, but you've got a new administration coming on, and you've tracked that very closely, especially healthcare. I mean, it's completely, you would agree, the system is messed up for consumers, end consumers, and you've got the new health secretary who is promising to really shake things up, and no one really knows what to expect. Do you expect an upheaval, and does it in any way? We don't know what's going to happen, and there are second order, third order effects. Do you think things will change the way sort of healthcare is delivered? Could it be as big? We'll find out soon enough. But what are your thoughts?
It's obviously very difficult to predict what this administration might or might not do. But I think if you just step back and think about it, most administrations, recent administrations in the US, the intent has been to reduce the total cost of care and improve the quality of care. And if you look at the provider organizations, the way they're going to achieve it is by trying to extract more and more efficiencies from these provider organizations. And we as a platform are actually part of that solution, right? We're actually able to bring so much efficiency into these providers. So hopefully we believe that whichever way the wind blows, we are actually part of the solution and not the problem. So we're hoping that regulations will remain a tailwind for us. Even if you look at it historically, the kind of regulations that have come through tend to have increased administrative burden for these provider organizations. And that usually presents as an opportunity to actually add to a platform. We're able to come up with new features and add on to a platform. So again, we'll have to take it as it comes. But we're hoping it'll be possible.
Just one more thing, and it's just coming to mind, so let me ask this question. Another recent listing, Sagility, operates in this space. Now, they're not your competitors just yet because I think they work with US hospitals and provide tech solutions for the US healthcare industry. But could they become competition? I mean, just asking a question that would be on people's mind. That stock's been doing very well after listing, by the way.
So actually, Sagility focuses on more on the payer space, the health insurer space. They're really not so focused on the provider space. We're purely focused on the providers, and within that $1.5 trillion segment of the physician clinic space. So not really competitors. Also, ours is a more platform-led strategy, which is fundamentally different. We're a platform as a service business. But yes, we have seen how Sagility has performed lately, and it's good for everyone, I guess.
Sachin, what kind of growth should we expect over the next? I mean, I know you can't be very specific, but broadly give us a sense. I mean, 24 over 23, we saw very large growth. What is the steady state revenue growth we should expect?
And if you could also tell us about your geographic breakup. As of now, it's mostly the United States. Is there an opportunity to de-risk yourself only from the United States market? I know you're saying it's a big opportunity, but any plans?
Yeah. So look, I think the tasks that we are focused on, these guys are spending $225 billion a year on. That market is growing at 7%. Of that, only 30 billion is outsourced so far. The outsourced TAM is growing at 12%. If you look at our historical growth rates from FY22 to 24, it's, on a standalone basis, we're 27%. So when you look at the outsourced TAM growing at 12%, our historic growth rates, our acquisition of Acuity and the massive customer base in which we can cross-sell, we feel very confident that we will far outpace the outsourced TAM growth rate of 12%. Beyond that, time will tell.
Far outpace 12% could be anything. I mean, give us a broad, a range. What should we expect?
Look, I would be happy to give you a range if I could. This acquisition is still a little new. if you just extrapolate our historical growth rates and the fact that now we have an even bigger captive install base to sell into, hopefully that should give you some sense.
And a lot of your work is outsourced to India. It's being done out of India. Just try to understand.
Yeah,
right?
so of our 13,000 people, 10,000 are across 7 cities in India. And where we apply actually 1,700 physicians in addition to the technologists that are writing the technology.
So it's like a KPO GCC model here in India? Like people sitting here and kind of doing the work.
But we remember they are supervising and supplementing the tech that we have built, and that tech does core of the task, and that tech is supplemented by the humans.
No, we were just asking because, come January 20, we will hear and, know the new US president's mind on things like outsourcing. So just putting out all the potential sort of issues on the table. Thank you very much for joining in.
Very much. Good luck.
And good luck.
Thank you
Thank you for having us.
Issue. Thank you. Okay, let's quickly move on. Lots of stocks moving around. One of them is Newland Laboratories. Vivek was telling us about potential large deals. Let's go back and get the details. Vivek.
Well, that's right. So, largely, like we indicated earlier today, almost 3.8% of the total equity of the company changed hands in a block deal. This particular deal was done at slightly above the floor price in the term sheet indicated as far as this particular deal was concerned. 15,900 is where the actual deal took place. Now, when you're talking about the term sheet, it did not actually mention the name of the seller. But if you look at the shareholding pattern and given the fact that this is a clean out trade, one particular entity that fits the bill as the likely seller is actually Small Cap World Fund. Now, we will have to wait as far as the block deal data that comes out later today is concerned to to actually go ahead and ascertain the actual seller, but most likely it could be this particular entity given the fact that it is a clean out trade. Newland Lab on the back of this particular deal is under quite a bit of pressure.
Okay, got it, Vivek. Thank you very much for that. Speaking of large trades, the other one on the radar this morning is obviously Nuvama, in which Edelweiss is likely to sort of have sold out its existing stake. Vamakshi, tell us the details.
Well, absolutely, it's a CNBC-TV18 News break. Confirmed 30 lakh shares representing nearly 8.4% of equity worth 2,100 crores. Exchange hands at 7,025 rupees per share. Now, sources are suggesting that the likely sellers could be Edel Finance and ECAP Equities, and this is expected to be a clean out trade because they had earlier sold, 6.2% stake in September, and they've likely sold out this remaining stake right now. Now, how does this news flow tie down to Edelweiss Financial Services? Well, ECAP Equities and Edel Finance are subsidiaries of the company. Therefore, some amount of money will be going to them. But apart from that, the second part of this is that keep in mind that on December 5th, Edelweiss Financials has announced that EAA India Alternatives, which is a wholly owned subsidiary of the company, had filed a DRHP with SEBI for an IPO, which will comprise of an OFS up to 1,500 crores. Now, the intention behind both of these stake sales is to bring down the debt at the corporate level. Keep in mind that on September 30th, 2024, the net debt profile for the company on a consolidated basis stood at 11,810 crores, out of which 5,480 crores is the corporate debt. So therefore, they're trying to bring down this corporate debt and strengthen their balance sheet. They also have outlined a plan for the same. Through the stake sale in EAA, they intend to bring down the net debt to 4,300 crores by September 25, and through the stake sale in their MF business, they expected to go down to almost 3,200 crores by September 2026. So largely this bodes well for Edelweiss. As of now, Nuvama is under pressure while Edelweiss Financials is up in trade.
All right, thanks a lot for that, Vamakshi. Well, let's move on. Let's focus on the jobs and the hiring trends here in India. The Chief Economic Advisor, V. Ananta Nageshwaran, last week stressed on the need for correction in wage structure by the corporate sector. Let's hear it out.
The staff cost of private listed companies, whether it is information technology firms or general, has been coming down. In other words, compensation growth has become weaker and weaker, compensation to employees. And if you take out managerial compensation, this will look even more acute, the decline. And of course, corporates have used the profits to reduce their leverage, which is a good thing. They are deleveraged, their balance sheets are healthy.
Oh, okay, all right. Let's discuss more on the corporate India hiring trends. We're also joined by the management of TeamLease. We have with us today in the studio, we have Ms. Ramani, the Chief Financial Officer at TeamLease. Hi, thanks a lot for joining in. Well, before we get to that commentary that we just got in, you're going to be having a board meeting, right, later this month, and you're looking at a couple of M&A opportunities. Could you tell us, give us a sneak peek, which sector could it potentially be in? You're sitting on a good amount of cash.
Yeah.
The sector of preference and how large could it be?
Yes. No, we have been actively evaluating M&A options, especially in the HR tech space, because there are quite a few startups and many products which are very interesting in terms of bringing in more productivity for employees, for corporates, and also tracking features like their attendance, leave, exit management, expense reimbursement. So we believe, since we already cater to 3,000 plus corporates in our staffing business, so these kind of options can bring in good value for cross-selling options, especially in terms of driving more HR products. So these are the areas that we are actively looking for M&As.
Size?
The ones which are currently in pipeline are smaller ticket size, about sub 50 crore. So overall,
there's a listed company. Ramani, hi, good to see you in the studios. Good morning. Zaggle Prepaid, I mean, does, on the employee side, HR side, sort of account expense management and things like that. In the same, I mean, I'm not sure you're familiar with the company, but something on those lines, essentially?
Something on those lines, but this is focused more on payroll-related management, expense-related management, employee productivity, other HR solutions. So this is in line with the one that you have mentioned.
Okay.
And you're saying the size will be small, maybe around 50 crores.
Yes.
This is all going to be funded via internal accruals?
Yes, yes. So the plan is to fund it through internal cash accruals, and in terms of contribution, the top line contribution would be very minimal because TeamLease is already over 10,000 crore in revenue. On bottom line this year, if I go with the current run rate, it would be about 5% contribution on profit. But the future projections are very promising.
And the cash, because this is going to happen through internal accruals, if you could just update us on the cash on the books.
Yeah, so we currently have about 350 crore of free cash on the books, and given the fact that this ticket size is quite small, we should be able to fund it internally.
Okay, so that's on the acquisition, small one, niche, but with good sort of scale-up opportunities, you're saying. I just want to sort of also take this opportunity to pull you in on the wider debate that's raging. The reason we played that CEA bite was that, this is not just in government sort of sectors, but we hear this debate around us as well when we're talking about the urban consumption slowdown, right? Whether this is partly because wages simply haven't kept pace with the rise in corporate profitability. So you tell us, I mean, and you deal with companies across sort of, the different ends of the spectrum. Do you think there's some merit in this argument that corporate India isn't paying as well as it's sort of profiting?
No, I kind of disagree with that statement, simply going with the numbers that we deal with, because for us, the salary inflation for the 3 lakh employees that we have on our rolls has been consistently between 6 to 8% year on year. Only for IT, over the last 1.5 years, it has been slowed down. It's like 2 to 3%. And that's more like a correction which has happened, like the hikes that were given during the 2 years of COVID time. It's more like last 2 years is a correction on that number. Otherwise, we are not seeing any kind of major drop or inconsistency in the salary inflation levels year on year.
So just checking, 2 to 3% growth in IT salaries. This is over the last year,
yes,
FY23, 23-24, as a correction to the sort of COVID era big hikes that were given out.
That's
got it.
Although I think the specific nuance point, Ramani, though, was, and I think the fact that salaries is a percentage of total expenses for companies. That I think you would agree over if you track. I mean, I looked at this data 5-6 years back. I mean, there's hardly any increase.
Yeah.
That is the point. Relative. I mean, that 6 to 8% is correct, what you said. But relative to corporate profits, I think that has essentially been. And I just wanted to. So the question there on the back of that data is, do we need help from the fiscal side in terms of spending, in terms of monetary policy? I mean, just your broad thoughts on that.
No, as of now, we are not seeing any kind of major policy intervention that is needed because, as I mentioned, so there has been a consistent salary inflation of 6 to 8% over the last few years. And even if I take last 4-5 quarters of our own hiring trends, barring IT, we have been seeing good momentum in terms of new job generation. When I'm talking about new job generation, obviously, this is about formal employment because many of these jobs are shifting from informal sectors to formal sectors, which is good because the contributions to PF, their access to insurance and other social security benefits will be improving. So we have been consistently adding about 20% net new employees year on year. And this is across sectors, be it BFSI, FMCG, FMCD, pharma, and now manufacturing is the fastest growing sector for us. So we are very positive on the outlook.
So just to go back and complete that point, you said that X of IT, the rest of the universe, the salary inflation average is 6 to 8%, right? Now, historically, how does it compare with the trends? I mean, is this always been the norm? I mean, 6 to 8%, and this is across sectors, right?
Yeah.
Is it on the lower side, or is it par for the course? I mean, this is how much India pays. How should we look at it?
Pre-COVID, this number is also about the same, 6 to 7%. Now that range has slightly increased.
To
so
6 to
7 has now increased to 6 to 8%.
Okay. Okay. All right.
Inflation, though, at what, 6%?
Yes.
Therefore, the clamour around whether with and inflation doesn't take into account a lot of the other costs, right? The lifestyle expenses that have gone up, and therefore the clamour around urban
and also the
slowdown.
education, healthcare, those expenses are not factored into inflation. In fact, we have seen the maximum increase in these lifestyle expenses also.
Very quickly, Q1 you grew by 18%, Q2 around 23%. Q3, how has it been? We don't want a quantitative number, but if you could give us a broad, has it been as good as what we have seen? 20% plus is what will grow in Q3 as well?
That's what we are targeting on top line, 20 to 25% growth. And in fact, H2, we are expecting almost 50% growth in terms of EBITDA over H1. So this is mainly driven by operating leverage in our staffing business. Our apprenticeship business is also growing very strong, especially towards manufacturing segment, followed by our EdTech contribution in H2. So all put together, a very strong EBITDA expansion in second half of the year.
All right, Ramani, it's a pleasure having you with us here in the studios. Thank you very much. A little micro, more macro today. But we look forward to speaking with you once you report the third quarter numbers sometime in January. Thank you.
Thank you.
Okay, well, we'll take a quick commercial break here. We'll come back and, focus on, of course, the market, which is, it's like a traffic light. Green, red, but red for now. 24,640 is where we're at. Stay tuned. Welcome back. Markets absolutely flat, 10 points lower for now. We have Vinay of HDFC Securities now joining in with some thoughts on the market and specific trades at all. I'm not sure, Vinay, good morning. Thanks for joining in. Not very much on the Nifty to show for it. And we've been in this range, right? 24,500 on the downside, 24,850 on the upside. So we got a break and we're right in the middle of it. So no indication so far. So any trades on indices and then your stock-specific ideas?
Yeah, so as you rightly said that Nifty is into consolidation and that narrow range of 200 points is there. So we are waiting for the breakout. So the probability of breakout on the higher upside is higher because the primary trend has been up and the inverted head and shoulder pattern which breakout was seen previously is still intact and breadth has been very positive. Small cap and micro cap indices have been hitting new all-time highs day by day and there has been 14 consecutive days of rising small cap and mid cap indices. So that gives the confidence that just for the timing it is consolidating in the Nifty and Bank Nifty, but ultimately we are expecting a breakout on the higher side. So 120, once we see a Nifty breaking about 24,710, then we can see a momentum, bullish momentum back into the markets. So we are waiting for that level to cross. Till then it can remain into consolidation. On the lower side there is a strong support at 24,400 that we are suggesting as a stop loss in the long side in the Nifty. And overall, we see a stock-specific market. There could be some running correction in small cap, mid cap because of the consecutive rise. But overall, I feel that the dip should be bought into and 24,400 should be the stop loss in trading in long positions in Nifty.
Okay, all right. Let's also talk about some stock strategies. What would you work with?
Yeah, so basically IT sector has been doing very well. In fact, in US market, we saw that Nasdaq index has registered a mark about level about 20,000 for the first time. So IT sector has been supporting very well globally, and in domestic market also we see a momentum continuation in the IT stock. So one of the mid cap IT stock I like is the Nasdaq, so which is trading around 3280. So around that level one can go long. I am suggesting a stop loss of 3240 for trading, and on the higher side we can expect a target of 3,400, so that will be a first trade. And the another stock which I like is the Radico Khaitan, which is a liquor company, is about to hit a new all-time high, and inverted head and shoulder pattern breakout is also there. So Radico Khaitan can be bought around 2480. Stop loss should be 2440 for the traders, and on the higher side I'm expecting a short-term target of 2,600. So two ideas, Nasdaq and Radico Khaitan.
All right, Vinay, thank you very much for joining us. Good speaking with you. Thank you very much for being here on the program. We'll take a quick commercial break here. On the other side, it's our special segment. It's the economy, and that will take the conversation forward on how the consumer is doing. Remember, Godrej Consumer posted a weak mid-quarter update. Lata will be in conversation with Amul and Bizom to understand trends in urban consumption. Is it slowing incrementally more, and how to navigate it? Stay tuned.
Welcome to It's the Economy. Godrej Consumer kind of scared investors when it announced to the exchange that its sales growth in Q3 as of mid-quarter was flat. Volume was flat. Separately, market research company Bizom shows that consumption of non-durables, like soaps, personal products, packaged foods, fell by 4.8% in November, although it rose by 4.3% in October. Now, the key reason for falling consumption may well be inflation, food inflation in particular, which has remained between 8 and 11%, as you can see in this chart, for the past 18 months, that is since July 2023. To understand whether consumption is really falling or at least static, is it a temporary slowdown, and what are the urban-rural features of this consumption, the premiumization features, I have with me Jayan Mehta, the Managing Director of Amul, or Gujarat Milk Marketing Federation, and Vishesh Dora, the Chief Growth Officer at Bizom. Mr. Mehta and Vishesh, thank you very much indeed for sparing time for me. Mr. Mehta, to you first. I don't think anybody will understand consumption as well as Amul. You have a national spread. Tell us, has Q2 was slow according to the results. Is Q3 also slow in consumption?
Good morning and pleasure meeting you, Lataji. This year so far has been very good, and we are looking at double-digit growth and more. The current Q3 is also the best ever in our history so far. We had a very good October and we had a very good November, and all looking at high double-digit growth. This season was good specifically because of the festive season, Diwali, New Year, and all falling in the same space. A lot of marriages, uptick in the rural demand. And so we have no reason to complain. This is the best possible quarter in our history so far of the last 50 years.
Okay. Well, Mr. Mehta, when you look at the inflation numbers, I'm just looking at the CPI numbers which the government releases, the prices of milk have gone up by about 3% annually. It was a much higher base, of course, a year ago, but it is still higher from those levels. And overall food inflation is also higher. So do you see, more premium products consumed, but less demand for plain vanilla milk? Anything you can give in terms of value add or premium?
As you rightly mentioned, dairy is not contributing to inflation, at least this year, because we've been in the headlines for the same reason a couple of years back. But let's face it very clearly. Inflation to consumers is income to producers. So if you want to compensate the farmers for the inflation, which otherwise urban consumers also feel, there has to be a reasonable price increase. And the RBI governor also said they're happy with 5-6% kind of an inflation. Fortunately, dairy is below that line. But more importantly, consumption of dairy products and value-added products. In our case, pouch milk is also a value-added product because a consumer or a housewife takes a very conscious decision to shift from loose to package. So this demand has been increasing. Packaged dairy products, people want safe, healthy stuff, and they don't want to waste the money on things which they're not sure about the quality. So this is one big tailwind for us, which is helping us grow the market and demand both in urban areas as well as rural areas. And we are fortunate that if the economy grows, the dairy segment grows slightly more than that. So we are very confident that this is a market which is a growing market. The kind of portfolio that we have, the price points that we have, and straddling from both mass market to premium segments with products like ice creams to beverages to ghee, which is the most expensive food item which every household consumes, to the butter and cheese, which have good demand both at household level, at HoReCa level, institutional level, out-of-home consumptions. And obviously good for both them, modern trade, for e-com, for Q-com, and also direct to consumer, apart from the GT
Mr. Mehta,
always do.
No, Mr. Mehta, is there a difference between mass consumption products and premium products, the rate of growth?
See, Amul is perceived as a value for money brand. So even our most expensive products are also perceived to be value for money, and they would be accepted by the masses as much as the premium end of the society.
No, I'm not saying anything is not accepted. No, Mr. Mehta, please, if you can give me some numbers, not just adjectives. What is the growth of mass consumption products? What is the growth of so-called premium products? There would be a difference between ice cream and milk.
Yeah. So ice cream is also double digit. Fresh milk is in mid-single digits at the moment. But the volumes and value base is much different in this case. So fresh milk operates across the country as much as ice creams. And we do invest into expansion of these particular categories, anticipating growth segment as we talked earlier. So, again, the same product in milk also, Amul Gold or Buffalo milk will be the premium segment, Amul Taza or Slim and Trim will be at the lower segment. But the consumption of all the product categories, to my mind, and the numbers that we have is pretty uniform and growing at a very rapid pace. And that's why as an organization, if we're growing at 15-20% this quarter over the previous quarter, everything has to work together. It is not just one segment can pull the whole market and take the brand to a different level.
Mr. Mehta, you're not getting what I'm trying to get at. I'm trying to ask you if you can give me clear numbers for... I'll just come back to you. Let me get to Vishesh. And what I want are clear numbers on what is the growth of the mass milk product, then the Amul Gold, and then probably ice cream and sweets. The rate of growth of each category. Vishesh, similar question to you. You gave us your November data, which looks less cheerful than the October data. Is consumption in some categories falling or under pressure?
So we're coming on back of a Diwali season, which in itself means that stocking in the market is going to slightly slow down. When we talk about what's happening in terms of categories, yes, there is a seasonal plus festive impact. So categories that are largely impacted are the ones which go off season because of winters, right? So things like, when you spoke about ice cream, stocking of ice cream is definitely reducing because of the onset of winters. If I talk about home care, that's another category which is impacted in the current month.
No, can you come again? So when you see your dairy is showing a minus 12% in November, would that largely be ice creams?
That is ice cream and ghee. So if you look at October, right? So we're coming on back of a strong September of festive October. That means stocking in at the retail point has been high, which is definitely showing in November numbers where stocking is falling. And this is largely a factor of ghee and ice cream what we look at. The other subcategories in dairy continue to grow.
Okay, no, but your numbers are not November over October, right? It is November over last year's November. And October is over last year's October. So November over November, you have a minus 11.7 for dairy, minus 6% for home care, minus 5.8 for packaged foods, and minus 8% for personal care. The others are doing well. Beverages, chocolates, commodities have done well, but these four have shown a minus of 6 to 8%. Are all these like under pressure only in November?
I mean, so like I said, right, we're following the stocking data. So yes, pressure is there in November, right? Again, just bringing out the fact that when we look at November's number compared to last year, last year Diwali was in November. This year it was in October. So you will definitely see that difference. But if you look at October and November in one go, it's pretty flat right now.
Okay. Well, yeah, last year I think Diwali was November 12th and this time it was November 1st. So yeah, that much of 12 days of difference was definitely there. But I didn't expect it to hit personal care and home care. Yeah, it can hit dairy products because people would consume more sweets. Mr. Jay Mehta, now if I can repeat the question to you. If you can give me some number for the ekdam mass consumption item, plain vanilla milk, toned milk or whatever it is, low fat, and for the more expensive products, what is the growth if you can give some numbers?
With the fresh milk business, again, volumes are equally split between the mass and the lower priced milk also.
Okay.
And the full cream milk and the buffalo milk segment has been growing at a slightly faster rate than the average milk that we have. Okay. But again, it's a function of geographical distribution. But year on year, month on month, there has been a growth across all the segments. The second is the retail part in which we mentioned Diwali versus Diwali. We track the performance of the top 200 stores in every single city that we operate. So November on November in Mumbai, my number of products and lines sold in these top 200 indicative outlets that we measure in terms of both sales turnover and volume, they increased by almost 50% year on year. Number of the turnover increased by about 29%. Okay. So while it is a market will respond differently over festive periods, depending upon the time of the year. But if the focus on distribution is there, then you can grow the market is what is the test case I want to present here. Having said that, ice creams continue to grow at more than 22%. Beverages also in these, which is typically, we didn't have a short summer actually this year, October, November. Still, we had 22% growth in beverages segment also. The rural distribution also has been growing at a much faster rate. Thanks to increase in number of distributor base, more deeper coverage. We added more than 600 distributors in last year. And this is also helping us growth. So 1/3 of the total business of Amul comes from town class, which is less than 50,000. And here, there also, we are seeing the growth in every single category that we operate.
Okay, Mr. Mehta, a very quick answer and a short one. Are you saying you're getting a lot of market because people are moving from, say, unbranded to packaged products?
Yes.
That's the source of your growth.
That's where the brand proposition comes in and the consumer's perception to buy good quality products, and Amul is value for money. So that's one big tailwind for this category that we operate in, and that is what is the pivot for all.
Yeah, I got that. I want the last word from Vishesh. Vishesh, if you have to look at the full year, Q2, we saw a lot of companies complaining about lower volume growth. It was across the board, especially for FMCG. Everyone, Hindustan Unilever, Godrej and the Marico's, Daburs, everyone complained. Is Q3 better than Q2?
I mean, currently it looks flat, but I truly believe December is going to be better, right? Especially when we talk about things like a commodity and a dairy, these continue to grow, backed on, of course, the inflation price, right? But yes, if I look at October and November this year, we are pretty flat. With the end of the quarter coming in, I'm sure the numbers are going to look much better.
Okay. All right. We will invite both of you at the end of the quarter or after the quarter is done to check whether things are better off in Q3. Thank you very much, Mr. Mehta and Vishesh, for joining us in this conversation. The key takeaway from Amul especially is that there is no dulling of consumption. In fact, people are moving towards branded items from unbranded. But Vishesh's Bizom data seems to indicate that there has been a dip in consumption in the month of November, which could be seasonal, but we will have to wait and see. Wrap up on Bazaar on that note. Chartbusters coming up.
Nuvama Wealth slips more than 5% after nearly 8.5% equity worth 2,100 crore rupees changes hands at 7,000 rupees per share. 7,025. Sources say Eagle Finance and ECAP equities are the likely sellers.
In another large trade, Newland Labs also sliced close to 4% after 3.8% equity worth 780 crore rupees change hands at an average price of 15,900 rupees a share.
Gopal Snacks under pressure after a fire breaks out as its production unit in Rajkot. The stock slips 5.5%.
Well, Concor is down close to 2% after the brokerage firm Goldman Sachs issues a bearish note on the stock. They've cut their target price to 710 from 810 earlier. They're citing further downside risks driven by weak growth. Hello and welcome to Chartbusters. I'm Nigel. With me is Mangala. Well, and as we speak, the markets are trading more or less flattish, a bit of a negative bias. The advanced decline ratio, though, that's turned around in the last few minutes. You have 800 stocks now advancing. At the start of trade, there were 1,800 stocks that were advancing. Mangala.
Absolutely, Nigel. We'll keep an eye out on that. Two indices on the top of our heads in the green, two in the red. Consolidation continues. It is the weekly options expiry. But the stock on our radar is Edelweiss. As you know, there was a large trade in Nuvama. ECAP and Edelweiss went ahead and sold about 8% equity worth nearly 2,100 odd crore rupees. We're joined by Rashesh Shah, who's the chairman at Edelweiss Group. Thanks a lot, Rashesh, for joining in. I remember, just when we last spoke, you were fairly bullish on the prospect